So we're all doing the test for Unit 4 Learning Commons review, correct? The final reviews will be on Monday and Tuesday. Friday, 12 to 2 p.m. this week Friday, and then next week on Tuesday from 12 to 2 p.m. Okay? So the first thing that they're asking us to do is to prepare journal entries. This entire review is journal entries, journal entries, journal entries. So number one, Cooper Company borrows $80,000 from New National Bank by signing a 6-month, 6% note. All interest and principal will be paid at maturity. So they want us to prepare the entry on September 1st when the note is issued. Okay? The journal entry on September 1st for when the note is issued will be they're borrowing $80,000. So that will be cash that they borrowed $80,000, and they're signing a note payable. So that would be note payable $80,000. So they borrow $80,000 from New National by signing a 6-month, 6% note. That's cash of $80,000 that they received, and note payable of $80,000 that they're going to have to pay back. Okay? Any questions on that? All right. Come around. That is pretty much the last one. Here. Please return them when done. No more. Yeah, I just told you I had one left and God took my last one. Okay. Part B, prepare the December 31st adjusting entry for accrued interest. So Part B, prepare the December 31st adjusting entry for accrued interest. How many months have passed at December 31st? 4, September, October, November, December. Correct. 4 months have passed, so we have to calculate the interest for 4 months. So we'll say $80,000 times 6% times 4 over 12. And then that will give you the journal entry on December 31st. Okay? $80,000 times the 6%, 0.06, times 4 over 12 is $1,600. Any questions so far? These are all going to be very straightforward journal entries. You want to make sure you know the journal entry. So the journal entry to accrue interest is interest expense and interest payable. Okay, every time you have to accrue interest, it's an adjusting entry, so it's going to be interest expense, and no cash is being paid, you're just recognizing it. So it's being credited to interest payable. Finally, prepare the entry to record the payment of the note at maturity. What is the date of maturity for the note?
February 1st.
February? What? February 31st. What day is February 31st come after? February 31st, guys. March 1st. Okay, September to all the way to March, whether it's the last day or the first. All right. So now we're going to record the payment of the note at maturity. So we borrowed the note on September 1st for cash. So we're going to pay back cash. There's going to be a credit to cash. We're going to have to debit the note payable for the $80,000, and then we're also going to have to calculate the interest expense. Okay? So you have the note payable, we just said $80,000. The interest payable from previously recorded $1,600 also is getting paid. the amount of cash paid is the 6 months of interest. 80,000 times 6% times 6 out of 12, that would be 2,400 plus the 80,000. Okay? You can calculate that either by doing the interest expense, either by doing 2 months over 12. I get this. Okay. So you can calculate the interest expense. You can either say the face value times your interest rate times time, where we had 80,000 times 0.06 times 2 over 12. Okay? Or if we did the other way using the full 6 months, we would have subtracted the 1,600 already from it. This would give us 800. And this is okay. And that would have given you the 1,600. Okay. Besides that, that's just the journal entries. Any questions on the note payable? Either recording or calculating the interest for it. Okay. Question 2. During the month of January, Preston Company's employees earned salary and wages of $90,000. Withholdings were $6,885 for Social Security, $14,200 for federal income tax. The company's unemployment tax was $3,150, and employees are paid on January 31st. Prepare the January 31st journal entry to record the payroll for January, and prepare the entry to record the company's payroll tax expense for January. So you have the first journal entry, which is recording the payroll, which is the amount that the company is going to pay to the employees. Okay? So, with that, you have the total amount of salary and wages payable of $90,000 that you're going to debit. Okay? And the credit, you're going to credit the withholdings for Social Security and the withholdings for your federal income tax. Okay? The difference between the gross, $90,000, and your withholdings is the amount that should go in your cash. It should definitely not be $68. Maybe it's $68,915. Okay? Okay? So your total salary and wages, $90,000 is your debit for salary and wages expense. You're going to credit FICA payable. You're going to credit your withheld income tax payable. If there's any charitable contributions, it might say you would also credit those. And the difference between your salary and wages expense and those withholdings is the cash that's going to be paid. Okay? The second part says prepare the entry to record the company's payroll tax. Okay? The payroll tax, okay, what we also are told is the company's unemployment tax was $3,150. and employees are paid on January 31st. So we also have to record the company's tax or payroll tax. And the company, for the payroll tax expense, is going to record the FICA payable. Companies match whatever is withheld from their employees' FICA. And they also have to pay the unemployment tax payable. You add these two up, and that will get you your payroll tax expense. Done? Okay. Okay. Everybody sign? All right. If you didn't, please sign for me before you leave. Are there any questions? I'm pretty much halfway done with the review already, and it's only been 20 minutes. So I want to make sure I slow down and make sure if you have any questions. It's going to be make sure you know the journal entries. Okay? Make sure you know how the journal entry for when you borrow a note payable, when you have to record the interest at a maturity date, and how to record the payback, and how to do the calculations for those. And then for this one is make sure you know salary and wages expense, and then what your withholdings are, okay, what you withheld, and then the cash that's paid is the net result or the difference between your salary and wages expense and your withholdings. With the payroll tax expense, you make sure you remember that the company is responsible for matching the FICA, and they also have to pay unemployment tax. You add those two up, and that will get you your payroll tax expense. Okay? Any other questions?
Where'd you get that 10,035?
10,035 payroll tax expense is just adding up your FICA payable and your unemployment tax payable. Okay? You just add those up, that tells you how much the expense is. And you get the cash here by subtracting your salary and wages expense minus your FICA payable and your withheld income tax. Okay? So, number 3. This is the part that gets kind of confusing. Shannon Company issued 1,004.5% 10-year bonds on January 1st, 2016 for $961,391 to yield an effective interest rate of 5%. Prepare the journal entries to record the issuance, the payment of interest on December 2016, on December 2017, and the retirement of the bonds on January 1st, 2018 at a price of 101. Okay? So let's do those journal entries. I'll put them over here first, and then I'll put it over here on the board. Okay, what's the first journal entry we have to do? Issuance of the bonds. Okay. So the issuance of the bonds, we have to do what? Are we borrowing or are we loaning out? We're loaning out. No, we're borrowing. Okay? Borrowing money. So we're going to borrow cash. Correct? Okay? And then we're borrowing this money by issuing bonds, correct? We're going to issue a bonds payable for this. Okay, is this bond going to be for the same amount of cash that I'm going to receive? Yes or no?
Yes.
The bond, I'm going to receive the same amount of money as what the bond says it's worth? Does anybody have a, who knows the answer? Who knows the answer? If the answer was yes, I wouldn't be asking who knows the answer. Okay. They are going to receive some cash. How much cash are they going to receive? $961,391. Okay. How much are these bonds worth? $1 million. Is that the same? No. Okay. So what is that? Is that a discount or is that a premium? Discount. Why? Because the amount of cash that I received, 391? The amount that I received is less than the value of the bonds. 1 million. Okay? So that means I need to debit what? Discount on bonds payable. Okay? The amount that you get is not the same. The difference goes to either the bond, the discount, or your premium. What is the amount of the discount on this bonds payable? $38,609. Okay. Do you all mind if I keep track of all this stuff? Oh, where is it? This is over here, right? 38,609. Okay, I'm going to step over here and I'm going to just keep track of everything that's going on. So I have a bonds payable, right? And that's worth how much? 1 million? But I didn't pay that much because I have a what? A discount on bonds payable. And that's going to reduce it by how much? $38,609, correct? Okay, so that's A. B, the payment of interest and the discount amortization on December 31st. What's the formula for interest expense of a bond? Formula for interest expense on the bond, how do you calculate it? Okay, we got somebody who knows some of it. All right, how do you know how much cash is going to be paid? Hold on. How do we know how much cash is going to be paid on a bond? I told you the answer just downstairs, just early before I went to lunch. These are the two parts you need to know. You got to know these parts because that's the only way you can get that journal entry done. Cash paid. All right, let's read back. Shannon Company issued a $1 million bond at 4.5% interest. Okay. They're able to sell the bond for $961,000 to yield an effective interest rate of 5%. What does yield an effective interest rate mean? To give the appearance of an effective interest rate. To give an appearance of an interest rate of 5%. What's the actual interest rate? 4.5%. Your cash paid is going to be based on that stated interest rate. Okay, it is which number times your stated interest rate. That is the your stated interest rate is that 4.5. I'm asking you, what are you multiplying it by? Shannon Company issued a $1 million 4.5%. It is their face value. However much I tell you, you will get $1 million times the stated rate, 4.5%. Okay? That is how much cash you will receive for the bonds that you paid 900-something thousand for. Okay? You will receive $45,000. Okay? The next thing you have to calculate is your interest expense. All right? We're going to have here for B a journal entry. We have interest expense that we're going to have to pay. All right, we're going to have to record. Okay? We also have to pay cash. Okay? Our interest expense. You guys have to know this. Who knows interest expense formula? Who knows it? Anybody think they know it? Okay, thank you. Carrying value. What is the carrying value?
961,391.
Okay. Carrying value is the difference between the bonds payable and the discount. Bonds payable minus the discount, the first year is the amount of cash you paid for it. Okay? So you do your carrying value times the market rate. What is the market rate? the same thing as the effective interest rate. Okay, same thing. My carrying value is then going to be how much? No, market rate is 5%. Carrying value is 961,391. 961,391 times 5% is how much? 48,069. And you can add the 5 cents in there. Okay, so I have my interest expense and I have my cash. Are they equal? Are they equal? No. Journal entries have to be equivalent, correct? Debits and entries? Debits and credits? Okay. So that means I need what? A debit or a credit? Credit. My debit is more than my credit right now. So I had a discount that I purchased. I added with a discount. I'm going to reduce that discount every year that I have to record interest. Okay? The amount that you will get amortized in that discount is the difference between the interest expense and the cash paid. Everybody understand? Are there any questions on this part? Any questions at all? No. Okay. This amount that we have here as a discount on bonds payable is amortized from your discount. This was originally a debit. This is now a credit. Let's go over to our T account and let's enter our credit. So this was in journal entry A. This was in A. Now in B, I'm going to credit it for $3,069. What is my amount right here? The sum total. Anybody? 35,540. Is that debit or a credit? Debit. Thank you. 35,540 debit balance. What is my new carrying value for my bonds payable? What's my 2017 carrying value? 964,460. Okay. Now I have to do journal entry number C. So now when I do C, it's the same as journal entry number B, except the numbers are going to change. Interest expense, discount, cash. Which number is going to be the same from B to C? Which number? Cash. Cash is $45,000. Every year you will receive $45,000. What is my interest expense for 2017? $48,223. Did anybody else get that? Somebody else got that? Yes? Nobody else got that? You might be right or you might just be wrong because nobody else got that. How did you get that?
Taking the 964, 460.
What is 964, 460? What is 964, 460?
Your new carrying value.
My new carrying value. So we take our new carrying value, okay? And it's going to put it in right here. 964, 460 times that 5% market rate, and that gives us 48,223. 45,000. My interest expense is 48,223. How much is my discount on bonds payable amortize this period?
3223.
3223. Everybody understand how we got that number? 48,223 minus 45,000. That gives us 3223. Okay? Any questions? What's up?
Stated interest never changes, so cash never changes.
Stated interest and that face value will never change, so your cash will never change. Whichever bond you receive when you buy a bond, however much it tells you it's worth, and however much it tells you it will pay interest on that, that's the amount of money you will receive for that. Okay? You are going to receive $45,000 every time if you loan the money to the company. Or in the case of the company will have to pay $45,000 every year. Year after year after year. I issued a $1 million at 4.5%. I agreed to pay that amount. Okay? What we're trying to get into context is the actual interest expense. Okay? It's accounting purposes. All right. So, that is C, the payment of the interest and the discount amortization. So now we have another discount, another amortization to take away from our discount. This is 3223. Our new amount is now what? 35,540 minus 3223. I got 32,317. Okay? So now they want us to retire the bonds on January 1st, 2018 at a price of 101. Okay? Yes, sir.
Where did we get the 38,609 from?
The 38,609, you got that from saying, well, if you paid this much amount for a bond that said it is worth that amount, then you received a discount. How much is that discount worth? That discount is the difference. 1 million minus 961,391 is 38,609. Okay, so that's where we got the original amount of that discount. Okay. Any other questions? Yes, sir.
Yeah, where exactly do we get the 48,000?
69. We use our interest expense formula. Interest expense is calculated by multiplying your carrying value
Oh yeah, I'm sorry.
times the market rate.
I understand that part. I was confused about C, where do we get the 48,223?
Okay, well in 2016 our carrying value was 961,391. In 2017 our carrying value is 964,460. So here you'll see me use 964,460 to get this number right there. Okay?
And you got 964,460 by adding the discount from the
But I got which number?
new carrying value.
964,460 by saying, well, I reduced my discount from 38,000 to 35,000. 1 million minus 35,540 is 964,460. What is my 2018 carrying value? $967,683. That sounds about right. There's two ways you can do that. I could have taken this and just added back this amount that I subtracted from, that I amortized. And that's another shortcut. So if I started here and I said, oh, I know my carrying value is 961,391, and then I discounted 3069, I can say, oh, plus 3069, 96440, and then I did 3069, and then I did 3223. $967,683. Okay. You just multiply your carrying value times that market rate, gives you that interest expense, and then the cash paid will always be the same. Discount, amortization will always be the difference. Now we are doing the retirement of the bonds on January 1st, 2018 at a price of 101. All right, we have the carrying value of the bond. So we know we are going to retire the bond. Okay, so when we issued the bond, it was a credit for bonds payable. So now we know we're going to retire it. Okay. We're going to retire the bonds. We have to reduce the bonds to zero, so it was credited, we have to debit it. We have a discount that we also had. Okay? That discount was originally debited. We are going to have to credit it, correct? Okay? In addition to that, we also have to pay cash to get rid of it. How much cash are you going to pay to retire the bonds? Oh, I'm sorry. Yeah, how much cash are you going to pay to retire these bonds? Yeah.
1,100,000.
Right. 1 million times 1.01. Okay? So we have retirement at a price of 101. So you take 1 million times 1.01, and that'll tell you the amount of cash that has to be paid. Okay? So this will be 3217, and then we're going to credit cash for how much?
1,100,000.
1,010,000 or 100?
Say 10,000.
1,010,000. Okay? 1,010,000 and 32,317 minus the 1 million. We need another debit. Yes. And that's going to be for the loss on retirement. The loss on the retirement is going to be how much?
10,000.
Yeah, 42,317. Everybody understanding this? Or are we lost? Who's lost? No? Everybody good then? Okay. 42,317. So we're retiring the bonds payable. We had to credit it when we issued it. To close it out, we debit it. We need to know how much we're going to have to pay. It says it was retired at 101, so we take our face value of 1 million, multiply it by 1.01, we get 1,010,000. Okay? Our discount when we issued had a balance of 38,609. After 2 amortizations, that value was reduced to 32,317. It's a discount, it has a debit balance, so we have to credit it to reduce it to 0, because we're getting rid of this bonds payable. The difference is whether it's a loss or a gain on the retirement. If you are retiring at a premium and it was previously a discount, you are going to have a loss. There is no other easy way to tell you whether it'll be a loss or a gain. It would always depend on whether, like if it was a discount this time, it would depend on how much the discount this was compared to the previous discount. The way you calculate whether it would be a loss or on retirement is by putting in your bonds payable amount for the face value. The cash is the amount that it's retired at. That discount is the amount you've been keeping track of for that year, and then the loss or the gain is a plug-in number.
So basically, to get the last discount, we have to do all of that.
Yeah, you want to make sure you're keeping track so that you know what the discount amount, if they're going to ask you, that, all of these problems. If they ask you the retirement of the bonds, yeah, you're going to have to keep track of that. If they don't ask you for the retirement, you're not going to need to. You're only going to need to know this only to get your carrying value. And you can do carrying value any of these ways, either of these ways. So if I know that I paid $961,391 and I figured out that a discount on bonds payable here is this much, I can just go back and add it to my carrying value for each year.
And
So
how did you get the loss on retirement?
the loss on retirement will always be the plug-in number. Okay? We will know how much bonds payable is. Bonds payable is a debit that equals the credit when you issued it. The cash will be that retirement rate. So it was a loss retired at 101. I take that face value of 1 million and multiply it by 1.01, it gives me 1,010,000. This discount was debited here. I have to keep track of the amount on the account, and I credit it as on the retirement. The difference between my debits and credits will go either to a loss or a gain on retirement.
And the loss is a plug-in number?
That's when we say a plug-in number, you will have to determine whether it is a loss or a gain based on the difference between your debits and your credits. Okay? Any other questions on that? All right, I'm going to bring up the neat version so you can just write down all the journal entries for that. So you'll see that they have 3 years, 2016, 2017, and 2018. Okay? The difference in the 316 and the 317, that first time they rounded up 4870 and kept the numbers round. I used 48,069 on mine. Okay? I'll be right back, ladies and gentlemen.
3609 to the 35540 on the discount again.
Oh, okay. So we started out with 38609. You see when we issued,
Yeah.
we had 38609 as your discount. Okay. So then when we have to calculate our interest expense, interest expense is two parts: your interest expense and the amount that was actually paid. All right. So your interest expense, we do that carrying value times the market rate. That gives us that interest expense. 48,069,070 is what it shows over there. Okay. The cash paid is just however much it is going to be, 45,000. The difference between those two is how much you're going to reduce your discount on bond spot. Okay, you're reducing either whether it's your discount or your premium. What you're doing when you pay that when you're paying interest is you're also reducing the amount of that discount or that premium. So we start off with it at 38,609. Once we do this first calculation, that's 4869 or 4870. That's 45,000. That difference, I take that difference and I'm going to go ahead and subtract it from my discount on bonds payable. And it just goes like that. All right? All right. Any other questions? Okay. Patrick Corporation is authorized to issue 1 million shares of $1 par value common stock. During 2016, the company has the following stock transactions. Issued 700,000 shares at $7 per share. Purchased 20,000 shares of its common stock at $8 per share. Declared 50 cents per share dividend to stockholders of record on December 20th, payable January 3rd, 2017. Journalize the transactions for Patrick Corporation. Okay? So, 3 journal entries that we're really going to have to record. January 15th, issued 700,000 shares of stock at $7 per share. This is $1 par value. It was issued at $7 per share. So that means there's $6 extra of additional paid-in capital. Okay? So, 700,000 shares at $7 per share. 700,000 times $7 is at 4.9 million recorded for cash. Okay? Common stock. This is $1 par value. $1 par value times 700,000 shares, and that is $700,000 in common stock. Additional paid-in capital, we just said it was sold for $7. Par value is $1. 7 minus 1 is 6. 6 times 700,000 shares issued, 4.2 million. Okay? Any questions? No? Straightforward? Very straightforward. Okay? Cash is the amount that's issued. Common stock is the par value times the number of shares issued. Additional paid-in capital is the difference for those two. Purchased 20,000 shares of its common stock at $8 per share. Purchased 20,000 shares at $8 per share. So very straightforward. $8 per share, 20,000 shares, $160,000 cash. $8 per share, 20,000 shares, $160,000 in treasury stock. Okay? December 6th, declared 50 cents per share dividend to stockholders of record. Okay? So how many shares are outstanding at this point? Yes, sir?
That would be the amount of issued stocks minus the amount of treasury stock?
Yes, sir. So we have issued 700,000. We have repurchased in treasury 20,000. So we have 680,000 shares outstanding. Declared a dividend of 50 cents per share. That means we're declaring dividends of how much? 340,000. I think that's about a good number. Okay? So dividends and dividends payable. December 6th, it is dividends and dividends payable because that is a declaration date. Okay? I'm going to pay dividends, so we record it in the dividends payable. That is it for 4. You're recording just the issuance, the repurchase of the treasury stock, and the declaring of dividends. Remember, when you declare dividends, it's just a declaration, so you're recording the dividends debit and the dividends payable credit. When it is paid off in January, that's when you'll record the dividends payable debit and the cash credit.
What was the January 1st?
January 3rd. So where it says declared 50 cents dividends payable January 3rd. On January 3rd, you would do the journal entry to say dividends payable, debit, cash, credit. Yeah, but they're not even showing it. They're not even showing it. Okay. 5. Stockholders' equity of Fleming Corporation at December 31st included the following: 4% preferred stock, $100 par value, 15,000 shares authorized, 10,000 shares issued and outstanding, common stock, etc., etc. Dividends were not declared on the preferred stock in 2015 and are in arrears. On December 1st, 2016, the Board of Directors declared dividends of $280,000 to the stockholders of record on payable December 31st. There have been no changes in the contributed capital during 2016. How much of the dividend is payable to preferred stockholders? How much is payable to common stockholders? Okay. Are the preferred dividends cumulative? Yes? No? Are the preferred dividends cumulative?
Yes, sir.
Yes, they are. Half of this job is reading. Okay? Once we see here that this says cumulative, that means what?
That they add up with
And that we have to pay them back for the years that have not been paid, or the years that are in what they call arrears. Dividends were not declared on preferred stock in 2015 and are in arrears. So we say we have $1 million in stock, and it's 4% preferred stock. So we take 1 million times 4%. 1 million times 4% is what? 40,000? Okay? So they are owed 40,000 per year for preferred stockholders. How many years do they have to be paid back? Anybody agree? Anybody disagree? Okay. 2015, 2016, 2 years. So you take 40,000 times 2, 80,000. So it says how much of the dividend is payable to preferred stockholders, how much is payable to common stockholders. So they declared $280,000 in dividends. We just said that we have to pay $80,000 to preferred stockholders. So that means the common stockholders receive how much? $200,000. Okay? Payable to preferred. $100 par times 4% times 10,000 shares issued. Or I could have taken that $1 million that they had, because that is the same as $100 par, 10,000 shares. The payable to common stockholders is the difference between $280,000 and the $80,000 issued to preferred stockholders. Finally, question 6. Following stockholders' equity accounts arranged alphabetically are in the ledger of Marvel Corporation at December 31st, 2016. Prepare the stockholders' equity section of the balance sheet. There is no calculation to do here. This is just making sure that you know what the what the stockholders' equity section of a balance sheet looks like. Stockholders' equity section. You have contributed capital. Your contributed capital will be your preferred stock and then any additional paid-in capital for your preferred stock. Your common stock par value, any additional paid-in capital for your common stock. All those added up is considered your total contributed capital. Okay? So that's your total contributed capital. You also have your retained earnings. You add those up, and you subtract out your treasury stock, and that gives you your stockholders' equity. It's just your stockholders' equity, where we've been teaching you it is your common stock and your retained earnings. Now we are teaching you that there's more than just common stock. There's also preferred stock. Anytime you show stock, you show the stock itself and its additional paid-in capital for that stock. Preferred before common, and that's it. Okay?